Welcome to the Ides of Macro, where we discuss investing, trading, and big picture frameworks, all through the lens of global macroeconomics. This is the bit where I remind you that none of this podcast is investment advice. In fact, this is purely for entertainment and educational purposes. But please do hit that subscribe button if you want the latest videos from Lycian as soon as they're available. And with that, let's get on with the podcast. Hello everyone, and welcome to the Ides of Macro podcast, where we talk about everything to do with macro. And this week, I'm very excited to have on Jesse Felder, who is founder of Felder Investment Research and has been a macro stalwart for many, many years. In fact, in the days when I used to do the publication platform at Real Vision, the reports by Jesse were the ones that people really anticipated and looked for, and were certainly some of the most popular that we had on our site, and we had over 50 contributors. So Jesse has someone who I have always respected, always loved reading his stuff when I've been able to get my hands on it. So welcome, Jesse.
Thanks, Roger. Happy to be with you.
And I think I'd love to really just get into it because, you know, here we are on the 4th of August, and we've just seen some quite interesting action in a yield, particularly those longer dated yields, 10-year yields, not quite broken to the highs yet, but they are starting to break out. And there's a lot of noise, at least on Twitter, about this. What do you think is happening here? What do you think is, firstly, the drivers of this? And do you think that this is an important change in the narrative compared to what we've really had over the last few months?
Yeah, absolutely. I mean, I wrote a piece towards the end of June titled "The Most Important Chart in the World," and I was referring to the weekly chart of the 10-year treasury yield. To me, from just a purely technical standpoint, it looks like since that October high, it's formed a bullish flag pattern, and it's broken out of that pattern higher. And a completed, bullish flag pattern is one of these kind of basic technical analysis things that you can look at. And essentially, it yields a projected target right around 5%. So I think that, people might be looking at this rise in yields and think, oh yeah, well maybe we'll test that October high. I think that there's a more important message there just from the technical side of it, that yields are probably headed on to new highs for the move. And in this piece that I wrote, I featured some recent commentary from Ray Dalio and Bill Dudley, who have been warning about this for quite some time, suggesting that the rapidly rising fiscal deficit is going to lead to a surge in supply of treasuries coming to the market, and they're going to have to we're going to have to see higher yields as a result of that. In fact, Bill Dudley, former head of the New York Fed, said he would be surprised if we didn't see turbulence, quote unquote turbulence, in the treasury market sometime this year. So, I mean, to me, those are very important signals, technically, and then from, some people who are very intimately familiar with the workings of, treasury markets, all kind of suggesting that the risk is to the upside for yields, and that's what we're seeing materialize this week.
And in terms of what's driving it, because obviously twin deficits is a story that's been around for months, years, it's been building and building and building, but it feels like something is slightly different this time. People are talking about, this issuance up to 1.9 trillion over the next, 6 months or by the end of the year. Is it that? Is it positioning? Are, asset managers in particular long? Because I know there's this speculative short, but a lot of that's against things like basis trades and other positioning. So it feels like there is a lot of length out there. There's issues around liquidity. Liquidity seems to have dried up a little bit. Or is it just people are worried about inflation and commodities starting to break out again with this reasonable move that we've seen in WTI? What do you think is the big story behind this move on this occasion?
Well, what we're seeing, and I haven't really seen many people talk about it, is a bear steepening in the yield curve, where the yield curve is steepening, but it's not, typically that happens when short-term rates come down faster than longer-term rates, and that's kind of what everybody's been used to seeing with the steepening of the yield curve. A bear steepener is when the yield curve steepens as a result of longer-term yields going up faster than shorter-term yields. That's what we've seen this week. And the traditional, interpretation of that is the markets are worried about inflation, right? The bond market is worried that the Fed hasn't done enough. And I think that's an important message to look at, especially if we continue to steepen as a result of longer term yields rising faster than short term yields. That would be a clear message that the bond vigilantes are back, so to speak, and they're not going to soak up this supply until there are more signs that inflation is going to be sustainably brought under control.
And just for the people watching that, the background there is we got to minus 100 basis points, and most people are talking about 2-year yields versus 10-year yields, and that was 2-year yields because they're higher than 10-year yields by 100 basis points. We got to minus 100. I think we've got back, as of this conversation, about minus 75, so 25 basis points of 10-year yields moving up faster than those 2-year yields. So that's the context that we've got here, and it does feel like there's this potential disconnect, because is this one of those scenarios where the yields going higher themselves, if they hit 5%, destabilize the underlying fabric of the market, including equities? Or do you think that the move that we get in yields and maybe these worries about inflation mean that the Fed come out and say, you know what, we're actually nowhere near done in tightening yet because we've got to make sure we get on top of this?
I think the Fed has been really clear that they're data dependent, right? They haven't said any. I don't think Jay Powell has suggested that they're ready to pause. I think he said that we're going to keep an eye on the data and be open to further rate hikes. The market has heard that and priced in rate cuts. So there's this disconnect. And in fact, I read a piece in The Atlantic this week by Derek Thompson, who suggested that what we're seeing now is, quote unquote, looks a lot like immaculate disinflation. Now, if you read, research affiliates, 6 months ago, 9 months ago, they suggested that just because due to the base effects, we were going to see disinflation in the first half of the year, just like we've seen, just because inflation in 2022 rapidly rose into June and then peaked and rolled over. So the year-over-year comparisons through June were always going to be really difficult and make it appear that inflation was coming down no matter what kind of the month-on-month trend was. But now we're at a point in time where those comparisons are going to start to get easier. And so if the kind of month-over-month trend in inflation just kind of maintains, we're going to see the year-over-year numbers start to go back up again. And as research affiliates pointed out, that disinflationary trend over the first 6 months of the year was probably an illusion. And this, the inflationary kind of re-acceleration could be an illusion as well. But I think that what markets may be missing is the underlying trend of inflation hasn't changed. That it's still probably well above the Fed's target, and looking at things like wages, in today's unemployment report and things, suggest that the labor market is still strong. There's still a shortage of workers in a lot of sectors. That's putting pressure. I mean, we're seeing it with all of these union negotiations and things. UPS and the airline workers, pilots unions, and things like this are all negotiating huge wage increases. Now, to me, that suggests that the Fed hasn't done near enough to rein in the inflationary impulses that are a lot, being driven by, demographic shifts. I think the underlying trend of inflation has a lot to do with just the shift in demographics, where you have a shrinking working age population relative to the overall size of the population. And the Great Demographic Reversal was a book that came out last year that really kind of made it clear what's going on in the global economy in this respect. And that's something that I don't think enough people are paying attention to. So, long story short, I think we've seen this illusion of disinflation, and now we're going to see it shift over the next 6 months. And it's going to be, I think the bond market is already pricing that. The bond market is already saying, hey, look, the Fed hasn't done enough. And that should be a clear wake-up call, I think, to equity investors that rates aren't going to come down in the way that they're discounting right now.
I always say that, what we've seen so far is this. Everyone talks about this pivot, and the pivot's still there, but that pivot started in March of this year, and it just gets pushed out. So it's actually been a plateau already, i.e., people are just pushing the pivot, pushing the pivot, pushing the pivot. Eventually, it's like, well, that means that your actual expectations were for no real change. But then I think the other thing which is fascinating about this as well, which is people are looking at core CPI, and yes, it might go a lot lower, but I get the feeling, given the way that the Fed has reacted, is that even if core CPI managed to get to zero, even briefly, if you've got a strong equity market, if you've got revisions to GDP that's up, and if you've got employment that's tight, strong, under 4%, they're going to be thinking, yeah, that CPI is going to rebound. So surely they're still kind of priming the gun to tighten, because the big story here is that everything's looking quite robust, and the lagging, very, very lagging CPI data, well, we know that's going to rebound. I mean, base effects from oil are going to have an impact in a few months' time. So do you think that the real driver here, if we're going to have any problems, is going to be from the back-end yields going up, or the Fed actually being much, much more aggressive, and therefore maybe 25, 25, 25, maybe another 50 to 75 basis points?
I don't think the Fed is going to be able to be more aggressive. I think that they'll probably be able to hold rates where they are. But I still think there's this issue of the lagged effects of the tightening that we've already seen have still yet to play out fully. And so I think we're going to see, it's interesting when I look at, how I approach markets and looking at all these different things, I've seen, the markets have come to fully discount, at least the equity market, the soft landing narrative. And I think we're starting already with the action in the bond market. You're going to start to see that unwind and shift back towards a stagflationary narrative, stagflationary situation where, you have nominal growth, GDP growth continuing to slow, and inflation turning back up again. And that obviously pinches real growth, and is not good for corporate profits and those types of things. So I think it's possible that the Fed will be forced to pivot, but I don't think they'll be able to do it with the Fed funds rate. I think they're going to have to keep the Fed funds rate at least where it is for a prolonged period of time, as they've kind of communicated. Where they might be forced to pivot, so to speak, is that if we do get this turbulence in the longer end of the yield curve, the Fed may be forced to kind of come in and unwind some of the, they wouldn't want to call it quantitative easing because that would create even bigger problems for inflationary psychology. They'd call it something else. But they may have to, step into the bond market at some point. And so it brings up, interesting questions to ask. What does that mean for equities? What does that mean for commodities and precious metals, et cetera?
And a lot of that's going to be down to, obviously, sequencing. And, sort of to encapsulate the last 18 months, we had a price shock at the beginning of last year. And in some ways, what we've had is little pockets of recessions, but not a recession across the whole economy at the same time, probably because we're still working through the dislocations of COVID. But then we've obviously come out of that and we've had this window of growth. But I think it's the thing that I thought was the most interesting, one of the most interesting charts, I think you may have posted it as well, was the one from Deutsche Bank, which showed that of the last 13 recessions, the average span between the first rate hike and the recession was 19 months. We're currently at 16 months in, and only one of those 13 happened sooner. Nearly all of them, if you had them on the equivalent trajectory, would be happening in the next 6 to 18 months. So again, based on the lagged effect of rate hikes, historically, 12 out of the last 13 recessions would still be in the front windscreen rather than the rear view mirror. So it does feel like that's, there's a lot of high-fiving, soft landing, but statistically, the recession would still be 2-3 months away at the earliest. So it feels that's the case. So sequencing-wise, and I guess this is where I'm trying to work out what causes what. Is it that we get the surge in yields that are a bit like in 2018 when we got to 3.25%, but maybe now it's 5%? Do you think it's the surge in yields that undermines what has been this kind of robust equity high-fiving scenario that we've seen?
The sequencing is the toughest part, right? I look at a lot of these leading indicators of recession and things, and whether it's Fed funds or there's a composite that I look at of oil prices, the dollar, and the 10-year yield, essentially. And it has a really consistent 2-year lead on the economic growth and corporate earnings. And so when you look back at, the rapid rise in the oil price, the rapid rise in interest rates off their lows, Fed funds, changing Fed funds rate from zero, and all those things point to and have recession in the second half towards the end of this year, second half towards the end of the year. Now, it's funny that, right, we haven't even hit the kind of that area, which really is over the next, 3, 4, 5 months, before people have already, declared mission accomplished. The Fed has pulled it off, the soft landing scenario. So, there's that side of it, which looks like we're entering in a period over the next, several months, where we should start to see the lagged effects of monetary tightening, of the rapid rise in interest rates and the dollar, really start to hurt earnings and slow down the economy. But at the same time, we have this massive supply of treasuries coming to market, and inflation poised to pick back up again, just from a mathematical standpoint. And so it looks like, those things could happen simultaneously, which is why I say, this soft landing narrative might be evolving back towards a stagflationary narrative again. And I think that, is going to be reflected in prices of everything. Bond market, I think, is already starting to price that.
Because for a lot of, when we're looking at the investment sort of outlook, and when I look back at historical recessions, etc., I mean, one of the definitive things of recessions is obviously unemployment going up. Sometimes recessions come because there's high unemployment picking up, or sometimes you get job losses because you're in a recession. But the two are coincident at the very basic level. One doesn't go without the other. But at the same time, it feels like corporates are going to hoard their employees whilst equities are high. So it's kind of, you're not going to get unemployment picking up until equities come down. So therefore, what's going to bring equities down? It feels like actually then, therefore, it is yields, which might be the lead indicator. But I mean, the pot of gold at the end of the rainbow is, what is the ring the bell number on yields? As I say, is it that 5%, or do you think that just breaking the highs that we saw from a few months back, do you think that might start to make sentiment change? Because it's that feeling, and you've written about this. Those tech stocks, people think are bulletproof now. They never are, but it's got to that. Do you think it's going to be something like those yields that cause the tech stocks to roll over, and then we start to get a bit of momentum on the downside?
I think absolutely yields, right? I mean, it makes no sense to me to pay 33 times earnings for Apple, whose earnings growth is actually in decline, when you have a risk-free rate of 5%. It makes zero sense. But when you look at the Magnificent Seven, as they call them, all together, part of what is happening there is, I think, their profitability as a group is being squeezed, and I'm talking about free cash flow margin, and this is as a value investor, kind of something that I look at even more than earnings and things, because I think what's going on now is this push towards AI. Right, I think this is coming because, and it was interesting to watch Microsoft kind of lead the way here, because Microsoft was very clear that we were starting to head into a year ago. We were coming into a difficult, I think, 2-year period. I think Satya Nadella said the next couple of years are going to be really difficult. Whereas you have the unwinding, right? There was a huge boom in demand for all these tech products, everybody working from home during the pandemic. And it pulled forward a lot of demand for tech products and services. That, was started to unwind last year. And it's also, if we're heading into recession, that makes that worse. So in some respects, it's very similar to that 2001-2 period, where in the lead up to Y2K, there was an overspending on tech products and services, and that left a vacuum for a couple of years. That really was catalyst for that bear market. But it was interesting that Nadella kind of came up, I think, with this AI. AI is not new, right? But he kind of decided to really go all in on AI right after saying we're going to have this difficult 2-year period. So to me, the way I'm kind of reading between the lines here is that companies focused in on these asset-light business models, whether it's software as a service or it's digital advertising, right? They've had it, the asset light business model has been wonderful, terrific profitability and growth for a long period of time. But I think they're through the pandemic, they've maybe reached the maximum growth rate potential that they've seen, and things are naturally decelerating because they've gotten so huge and because they've tapped many of the markets that were untapped for so long. And so maybe the extent of these asset light business models is nearing its end point. And now they're investing massively in an asset heavy business model, right? They're having to build these massive data centers and things, which are hugely expensive to power these AI type of business models, which haven't even been proven to be nearly as profitable as their base businesses. So the way I read this is these companies are transitioning from asset light to something that's really asset intensive, capital intensive, and they're spending massively in CapEx. We saw this in Google and Microsoft. I mean, they're ramping up CapEx like crazy, which, like I said, really pinches their free cash flow profitability. So right now, as a group, these Magnificent Seven stocks trade in aggregate more than 60 times their free cash flow. And this is a result of falling free cash flow and rising valuations, which I think sets up a really big problem for them if AI doesn't prove to be as profitable as their asset-light lines of business were, software as a service, on things where they didn't have to invest massively in them. I think when you look at the history of these really capital-intensive things, and especially in technology, right? Technology becomes obsolete very rapidly. It needs to be upgraded on a regular basis. It seems to me that it's not nearly as an attractive a line of business as their main business lines have been. And for that reason, they probably should deserve an even lower multiple for the less profitable growth that they're now pursuing. But things have gone the other way. So it sets up an interesting situation where either AI will prove massively profitable and justify the valuations, or like most really capital intensive businesses, it will prove less profitable and deserving of lower valuations. And so I think that will take time to play out. But rising cost of capital and things and risk-free interest rates certainly aren't a tailwind to valuations at this point.
And how do you think we get the market to move back into really caring about effectively fundamentals, things like valuations, your classic metrics? Because one of the things we've seen over the last 10 years is the difficulty that active managers have had in the rise of passive. And when I mean passive, really those rules-based funds. And I think now, if you had a world which was 100% algo, quant, rules-based, where things like volatility and momentum mattered and valuation less so, actually this could carry on until we see a break in the true economy and the money coming in from, let's say, 401ks starts to dry up. How do you think we get that actual switch so that when we go, these are overvalued companies, and it now matters that they're overvalued? Because it hasn't really mattered for a long time, because the flows just keep coming in almost regardless of what's happening. Again, do you think that goes back to another move in the yields at the back end, maybe more interest rates, a bit more inflation? Is that the thing that's going to kind of ring the bell and shift us back into we care again?
Yeah, I mean, it's a great question. And I think, you brought up the point of, the Fed watches financial conditions, and financial conditions are partly driven by stock prices and spreads and these types of things. And Jay Powell was asked about this at the last Fed meeting, financial conditions have actually loosened significantly, right, with the rise in stock market and the narrowing in corporate spreads and things. And his answer was that, these things, go in waves, but eventually we'll see, financial conditions align with monetary policy over time. And so I think that was his, thinly veiled way of saying, yeah, we're going to remain tight until the market starts paying attention to valuations again, right? So there can be, market can rally for a time and spreads can narrow and all these things, but we need financial conditions to tighten, and we're going to do whatever it takes to see them tighten. And that's basically saying we're going to keep, raising interest rates or keep them at a high enough level to see financial conditions tighten again, which is, till the stock market comes down, spreads start to widen and show signs that the economy is kind of loosening up a little bit from this really tight labor market. So I think that's probably the most likely way that we get through in the short run is Fed policy just remains tight until the stock market finally bends to its will.
And with that, I mean, it's the sort of trying to think about the, again, it's the sort of sequencing, because what we keep on seeing is when we do get a move in yields and then other risk assets start to get a bit nervous, then yields come back down again. It always seems to have this sort of balancing mechanism. And it feels, and I guess this question will come back to you, is do you think that we get a recession that's a natural recession, i.e. we're just going to progress into it, with that maybe another 3 or 4 months lag since that first rate hike? Or do you think we need to see one that's effectively manufactured either through yields or the Fed? Because the battle that seems to be in the bond market at the moment is don't get too short bonds because we're going to go into a recession. Whereas it actually might be that it's only when we see those yields go higher that we'll actually then get into recession. So do you think we get a natural one, or do you think we still need the Fed to manufacture one?
Yeah, I think that the Fed has probably already manufactured one, and that's basically like I said, the 2-year lead on oil prices, interest rates, and the dollar is very strong a leading indicator. Oil prices were negative, right? And actually, when you saw rates come down dramatically, oil prices crash and go negative, and those things basically set the stage for the really strong rally in economic growth and earnings that we saw into early of until about a little over a year ago. But now the rapid rebound in those things has essentially, as my friend John Husband likes to say, a recession appears to be like baked in the cake already. We've already had these things happen: the rapid rise in interest rates, oil prices, and the dollar. And it's just now playing out. So I think that probably they've already done enough. The market, just like it does in 2007 and 2000, and in between every tightening and the onset of recession, you get this soft landing narrative. I mean, so many people have documented it so well that, you get the tightening and then everybody looks around and goes, wow, no recession. I guess, it gets green light, all clear. Right before things, plunge down into recessionary episode. And I think a few people have pointed out the revisions to the to unemployment numbers, to the jobs numbers. We've seen 6 downward revisions in a row. That's only happened in late 2007 before. So there are signs now in the jobs market, which is obviously a lagging indicator that things are slowing enough to get to recession. Now, I think we need to differentiate. I don't expect a 2008 style recession. I think it's probably more along the lines of that 2001-2 type recession, or even look back to the 1970s and in that 73-74 recession, I don't think nominal GDP ever fell below 7% year-over-year growth. Right? So how do you get a recession when nominal GDP is still growing 7%? Well, you get inflation going up to 8-9 again, and you get an uptick in unemployment. I think probably that 2001-2 episode, was not. We didn't have much of a recession. It was a very mild recession, but Nasdaq came down 90%, and and we did have a technical recession. I think that's more along those lines is what to expect here. I think people with due to recency bias or whatever think recession, and they think 2008. They think everything has to crash all at once, including commodities and precious metals, and interest rates have to fall to the floor, and that's what recession looks like. But that's not necessarily how it looks typically, or how it's going to play out this time.
And you made some really, those comparisons there are really interesting because, and I guess the equity market is what a lot of people will think about. Do you think we're going to get a significant recorrection or correction? Because, it's great. We can all predict recession, but if equity markets just carry on up, what was the point? Do you think that this is a recession which, like you said, 2000 to 2000 and effectively 3 was the 50% pullback on the S&P and 90% on the NASDAQ. But then we've had recessions like 1991 and the second recession in the early 80s, I think it was 82. And even, they hardly pulled back at all. What do you think, for the equity market? Do you think that this is a broad, across the board, index level pullback of significance? Or do you think it's going to be those stocks will get whacked, those stocks won't, and therefore it's actually going to be quite a disperse reaction within the equity market?
Yeah, well, the reason I think it's more like the 2001-2 timeframe is that when you look back at that, NASDAQ was down 90, small caps essentially flat through that entire period. Now, I'm not necessarily bullish on small caps. I think something about, people point to the cheaper valuations there, but something like 40% of the companies are unprofitable, and the PEs exclude those companies. So, but I do think what's kind of similar to that previous period was it was characteristic of a rotation out of technology and into commodities and precious metals, right? The oil price bottomed in 2001-2 and went on to just a spectacular 10-year move higher for oil and energy stocks. Same thing in precious metals. And it coincided with a major peak in the dollar in 2001-2, which was and rolling over of the dollar, which coincided with a change, an important change in the fiscal situation, where we had a 99-2000, we actually had a fiscal surplus briefly, but then that structurally changed to where you had a widening, a trend toward a widening deficit for years to come. And there was no coincidence that the dollar peaked at the same time and rolled over into a major bear market. So I think what we're in the midst of right now is that negative price on print on the oil price a couple of years ago was a very important bottom for commodities more broadly. And ESG, the popularity of ESG and all these things were, I think, a very important sentiment signal towards the commodities space, which has seen dramatic underinvestment for years now. And if you just, subscribe to the idea of a capital cycle, we've had these companies, the resource sector has been dramatically starved of capital for years. And so we're significantly undersupplied at a time when demand is structurally going to be headed higher for a long time as a part of greening, trying to green the economy and things. And so I think we are, in the early innings of a commodity super cycle, very much like we were in 2001 and 2. And at the same time, that suggests inflation is also, and interest rates have bottomed and are now in an important uptrend, which would suggest that valuations, record valuations of equities, probably lead to a significant period of underperformance. I mean, we saw the lost decade in the stock market from 99-2000 until the early 2010s. And I think that's probably what we're staring at for the coming years is a rotation from financial assets to real assets, and so I that's kind of my thesis for the next several years.
For people who, let's say, long only, because there's a great, effectively there's potentially a very good spread trade on there, but if we do get even a mild recession, we should probably expect headline indices to come down, and even some of the commodity stocks will underperform in that. Would you say it's worth picking stuff up now, or would you say, okay, let's wait and see if we get this recession because we might get better prices? How would you play that? Because this great story is going to play out over the next decade, but people might get their stops hit if they go in now and even fall 10-15% with tech down 50. So what's your way of playing that sort of potential outlook?
The sentiment towards the commodity oil and precious metals, I'll just address specifically, and I mean even copper and things. The sentiment got so negative recently because of the worries over recession. And when you look at how the oil price acts, everybody thinks I don't want to buy energy stocks. I don't want to buy oil because we're headed to recession. Well, what oil does typically is it discounts recession in advance, And as soon as the recession starts, oil prices start going up again. Well, why is that? Because the oil price anticipates the fiscal and monetary response to recession, which, and eventually creates greater demand and all these things. And so if you're just looking at the oil price from that standpoint, you could say that this year, the first 6 months of this year, the oil price has already discounted recession, right? It's down 50% from its highs in 2022. To me, that's oil discounting a recession. Now, what's interesting is since the start of July, oil price has gone from under $70 to now over $80 a barrel. So, I think from that standpoint, it wouldn't be crazy to suggest the oil price might be suggesting that recession has already started, and that we're going to start to see some some potential inklings of monetary and fiscal policy addressing the slowdown in the economy. Gold price, kind of the same thing. Look back at that 2018 Jay Powell, the famous Powell pivot, right? Gold prices bottomed a good 3-4 months before that last rate hike, anticipating the end of the rate hike cycle. And then, by the time Jay Powell said they were done, months later, gold price was already ripping to the upside. And I think we've seen the same thing in gold, where you've seen the gold price tanked, in September, October of last year. And if it's operating kind of on the same time frame as it did in 18-19, then that would suggest that the gold price has effectively timed another end of the rate hike cycle, the Fed is probably done. They're not going to hike again. That doesn't mean they're not going to hold interest rates where they are for a prolonged period of time until financial conditions behave the way they want them to. But I think that, from the commodity sector, it's not outrageous to suggest that they maybe have already discounted recession, and now they're discounting, what are things going to look like 18 months from now? Well, we could get massive stimulus. We could get, these types of things again, especially heading into an election year. It's not outrageous to think if we have a recession going into an election, that there is going to be some kind of outrageous stimulus, and which would be very bullish for commodities.
And in fact, that gold chart is a thing of beauty, and 2050, 2075, and it's close, it's great. And you are one of two people I saw mention getting quite excited because we had yields going up, but at the same time the gold price was trying to go up as well. What were you thinking behind that? Because you were basically saying that normally high yields is bad for gold, but actually gold going up and yields going up is maybe an anticipation of something. So maybe it's time to re-engage with that gold story. Can you just outline what you were thinking there?
Yeah, I think there's there's a risk, and I don't even know how to put a probability on it, but there's a very good possibility that we see a inflationary spiral, right? Where we're seeing the interest on the debt, the federal debt, rise so rapidly, right? We're now at more than $1 trillion annual rate just of interest. And, if commodities take off again and the Fed has to raise rates higher, we're going to see a lot of the debt, all the debt, kind of reprice at higher rates. I mean, the federal government is still paying a relatively low rate of interest on the debt in aggregate because so much was issued at lower interest rates. I mean, if you reprice everything at higher rates, it becomes extremely problematic, where I think it becomes obvious you have to print money in order to just pay interest on the debt, and so there's a not minuscule probability or possibility of the Fed running into real problems with its inflation fight, where they can't, ideally, I think what the Fed would have done was been very, very aggressive in raising rates to begin with, to really try and nip inflation in the bud. and err on the side of hawkishness, which I don't think they've done. If you look at things like the Taylor Rule has suggested for a long time the Fed funds should be closer to 8, 9%, 10%, right? We're at 5 now. So in that case, if they had been able to nip inflation in the bud, then they wouldn't have had to worry about these other potential problems. But now you're kind of entering a situation where if the inflation genie is not effectively put back in the bottle and inflation picks up again and the Fed has to do more to fight it, it further erodes the fiscal position of the U.S. government, causing bigger problems where then they have to issue even more debt just to kind of pay the interest on the debt. And, that puts the Fed in a very, very difficult position where I don't think they can pursue, they're going to reach the point where they're not going to be able to pursue quantitative tightening anymore. And the thing that I maybe worry about the most is when we get to that point, when the Fed has to end quantitative tightening, if the inflation genie is not back in the bottle, that inflation psychology could shift in a way where saying, well, the Fed's hands are tied. The Fed doesn't have the ability to rein in inflation, and that could be, a really big problem. I think that's what Paul Volcker's biggest success really was breaking, not just breaking back of inflation, but breaking the back of inflation psychology, right? By saying we're going to do whatever it takes to rein in inflation, and having the ability to do that because debt levels were relatively far lower back then than they are today, really gave confidence, people confidence in faith in the Fed's, abilities. That faith, I think, is going to potentially come under question, and that's maybe the most dangerous kind of inflationary development that you could see.
And do you think this is going to lead to some form of yield curve control appearing in the US? Because if we do get a disanchoring, whatever you call it, of inflation expectations, i.e. they start running away, yields start moving, yields, if they lose control of the long end of the curve, causes all sorts of untold tremors in other areas. Maybe we have problems again with the banks, mortgages, another whack in the head on that, obviously, for those who actually want to move or buy the house. Do you think that they come in with yield curve control? And if they do, doesn't that potentially support the equity market in general, but also actually, if you cap yields, doesn't that help some of the tech stocks? So do you think it's one of those things where, again, you get this sort of counterbalance almost, is the potential that it's constantly 2 steps that way, 1 step that way, 3 steps that way, 2 steps that way. And we never actually have the big kind of splurge or the big denouement that you want when you normally get that cathartic event in the equity market?
Yeah, I think we probably are headed towards some kind of yield curve control. Who knows if they'll call it that? But the naming of these things seems important for psychology purposes. But I think what will end up happening is you look at essentially over the last 2-3 years, we've taken modern monetary theory as a thesis, as a precept, and we've implemented it in the real world. We've said we can print as much money as we want. We can give it to people. And it won't be a problem, sustainably. But MMT also says that if inflation results as a part of this, it's not up to the monetary authority to deal with it. It's up to the fiscal authority to deal with it. And I would absolutely agree with that. That the Fed's hands are essentially, they can only do so much to address this issue. When you have an 8% deficit to GDP, which is equal to the worst of the financial crisis during a so-called economic expansion right now, with unemployment at 3.5% or whatever it is, I mean that's absolutely insane fiscal policy, I think. And so, we have it. If inflation proves sustainable or is becoming a problem reaccelerating to the upside, the Fed will have to implement yield curve control, but then it will be incumbent upon the fiscal authorities to say we have to do what we have to do in order to address this problem. Also, we can't just leave it to the Fed and hope that they fix it. And that probably means raising taxes. Well, what's the easiest the lowest hanging fruit in that regard. It's undo the Trump corporate tax cuts. So, that's kind of what, the prescription MMT gives us, right? We've pursued MMT. We've seen the inflation that everybody warned would result from MMT. And now we have to use the MMT prescription to address the inflationary problem. And that's raising taxes in order to try and narrow the deficit and just kind of reduce the fiscal stimulus that's going on right now. So, I think we probably get to that point where the corporate tax cuts have to be reversed. And so, while people might view yield curve control as, bullish for equities and keeping down the yields in the long end, I think we're going to see, the Fed is not going to be able to lower it on the short end, which keeps a lot of money on the sidelines in terms of, I want to earn the 5%, but also there's going to be a shift on the fiscal side, which is probably even more bearish for corporate profits than anything else.
And it's that sort of incredible tightrope that they're on, because the fiscal side of it was, and if you just go back, monetary during the last decade didn't really have much impact on inflation. It was only when you had the dislocations with COVID and the fiscal putting money in everybody's back pocket. And if you give the average person money and they spend it, that's the inflationary bit. If you give rich people money, they buy art, and it doesn't have that much impact on inflation. Problem I guess we've got now is the employment and wages is where you get your sticky inflation. And they're being given fiscal support. So you need to take fiscal acts to the corporates to try and effectively get them to increase unemployment. So it's kind of, you've got to feed them and you've got to take it away. And it feels like that though it's a multiple month, maybe even a multi-year process. So this feels like it's going to play out not in sort of like, we're going to get one of those sharp sell-offs within the equity market, recession for 2 months, 3 months, 2 quarters, and then bounce back out. It actually has to play out over maybe 24 months or longer.
Yeah, I mean, I hear you asking the sequencing question.
I'm trying to make money out of you.
It's the most difficult question to answer. I mean, for me, it's, I think, a lot easier to just kind of see these trends playing out. And you're absolutely right. It was the fiscal stimulus that really resulted in the inflation. And with the deficit widening again, essentially that is, still at work in the market and probably going to lead to inflation coming back again. I don't know how long. I mean, right now there's zero. I think there's some Democrats in Congress that would love to undo the corporate tax cuts, but most of them don't want to vote for that. Right? It's really difficult to vote for any raising of taxes if you want to get reelected, which is why both sides of the aisle, nobody's talking about it. Nobody's worried about the deficit. If anything, you hear talk in Congress of, people have been warning about the debt and the deficits for years and years, and it hasn't mattered. And so that sentiment of nobody cares is what's literally driving, this problem to a level where everybody's going to have to care. I don't know when we get to that point, but it feels like the bond market is starting to suggest that we're approaching that point where you guys are going to have to care again, and so that's why I think I've said the 10-year Treasury yield most important chart in the world, because you would think that with slowing in the economy, whatever, rates should be coming down. The bond market's not acting like it should heading into recession. So, it's acting, as if there's another problem going on. And I think it's saying inflation is a bigger problem than the potential for recession. That's something that everybody needs to pay attention to. Politicians, typically pay attention to rates, but the fact that they're not means they might have to go up to a degree, that's going to really scare some positive change into the mindset in Congress.
In terms of the way people can play this, and I'm thinking more sort of individual investors rather than institutions, because if I was an institution, I'd be looking at a short-term trade on bond yields going higher. So if I was massively long, I'd want to reduce my position. Okay for institutions, yes, there's things you can do in TLT, but relatively harder for retail. So it looks like maybe the accumulation in gold is a good way to play this, because we're still below the big level of 2050, 2075. So we've not missed it. What we don't want to be doing is chasing it at 2100, 2150. So gold sounds like a good way of playing it. You like the rotation into, it sounds like you're probably more in favor of the energy sector first. And then do you think things like the miners, do you think start with energy, because you say energy tends to have, we still use oil during a recession, even though some of the stocks get hit, but stay with that. Are there any other things that you're looking at as ways of just positioning? Because it seems like with the run that we've had, yes, people still have the fear of missing out on this big equity run, but we just want to be starting to cut back some risk, spreading it out a bit, maybe a little bit more cash than people have carried for a while, things like that.
Yeah, I think you pretty much nailed it there. I think I'm still very interested in the energy sector. These stocks are trading as if oil prices are going back down, below $70 a barrel sustainably, and I think that the supply and demand. I mean, we just had the biggest weekly drop in supplies on record, and demand was just recently revised to record highs. So the supply-demand situation in oil is suggesting that oil prices are not, headed lower anytime soon. And even in the scenario of a mild recession, I think that the fact that the supply situation here in the U.S. is not nearly as bullish, in terms of production, as a lot of people would believe. I think my friends at Gehring and Rosenzweig have pointed out that the Permian Basin is the only place where there's any kind of growth in production left, and it's very near peak production. It's starting to roll over. So I think energy is still really interesting. The stocks are incredibly cheap. I mean, the free cash flow yield there is double digits, whereas you have the free cash flow yield in things that have been popular, is low single digits. I'm talking like 2% free cash flow yield, 3% for a lot of these big tech stocks. That's not attractive to me in an environment where I think the risk-free rate is high and potentially going higher. Inflation is a problem, and I think that you have to own some precious metals, as an insurance policy against these types of inflationary dynamics that I've been talking about. It's fascinating to me that gold is very near to breaking out to new highs again. We're at 1940-ish. Right now, just below record highs. To me, it looks like it's coiling, getting ready to break higher. And you hear zero talk about it, right? There's zero flows into ETFs. There's zero news stories mentioning gold. To me, that's the most bullish sentiment signal that you could have. The last couple times gold prices tried to break above 2,000, right? You had sentiment go through the roof. You saw it in the commitment of traders reports. You saw it in ETFs. You saw it in news articles. Now nobody's talking about it. To me, that suggests that this is potentially the time when gold price is going to finally break higher in a sustainable way.
I mean, it's fascinating that you say that, because I've been doing some work with people looking at things like junior miners, gold, etc., but also across the whole mining space. And not only these people saying the sentiment is the worst I've ever seen it in these stocks, but also when we've posted videos on this stuff, 2 or 3 years ago, if we did anything on gold or gold miners, it'd be like, yay, great, we love these. Now this is ridiculous, we hate them, this is pointless, yes, we've heard this story before. It's a bit like uranium in 2017 when people were talking about that and it just carried on going sideways. So I've never seen the comment section and general sentiments in, for instance, junior miners in every part of the mining space as awful as it is today. So it really backs up your point that this potential to actually have legs if we break is very much there, which I think is a reason to maybe start believing, certainly to start accumulating. One of the things just on this is that what you talked about there, you're talking about commodities, you're talking about the dirty cyclicals, as I used to always call them. Now, for those people who are watching this, who maybe are international investors, do you think that if the Magnificent Seven are getting hit, and this is a story more for commodities, do you think that for an international investor, you probably should be reducing US weight and maybe looking at emerging markets or elsewhere? Because if the Magnificent Seven are coming down, then the headline indices are going to underperform because they're going to be giving back that outperformance of the last few years. So do you think for an international investor, if they're overweight significantly in the US on their portfolio, that they maybe should be moving some into an international sort of space?
Yeah, absolutely. I mean, just as a value investor, U.S. market is so much more highly valued than any other markets around the world, with maybe the exception of India. But typically, other global equity markets are significantly cheaper, and I'm also bearish on the dollar longer term because of the trend in the U.S. fiscal situation. I mean, you look at just the trend of the price of the dollar and the trend in the deficit, and it's very clear they kind of move together over longer periods of time. So, the budget office has suggested that the deficit is on an inexorable path wider, right? To me, that suggests I don't want to be long dollars. I want to, I want to own other things. And so I think from the standpoint of both, yes, the equity market is probably as overvalued as it's ever been. And the trend in the currency is probably not a good thing either. I would absolutely be interested in owning other things, in almost anything other than those two things.
Fair enough. I mean, a lot of people actually said maybe the thing to look at is some of the emerging markets in the North American, or at least in the Americas, because as we get all this sort of not so much deglobalization but regionalization, some of the emerging markets that are going to be feeding into places like the US, which ultimately, it's still probably going to be a relatively robust economy. There are those opportunities. And you say a lot of people hate being explicitly short the dollar, but you can be implicitly short the dollar by being long some of these emerging markets. And if they're feeding into the US and the US holds up, even with the dollar coming down, then I guess that's one way that they can play it as well. Brilliant. I mean, thank you for that. I mean, what's good about this is it's actually a sort of, so many times I hear this really negative view and oh God, the world's going to end and get your hard hats on. But actually, it's actually a nice, rational kind of relatively, okay, that's probably going to underperform. That might outperform. It's not going to be a terrible recession. It's not 2008, but we just got to be wary. And it just seems like the thing that we all should have right on our radar screen, front and center for now, is stare endlessly at the 10-year yield and see how far that's going and how quickly that's going, because that could be the light paper for something a little bit more dramatic.
I mean, just simplify it, right? The simplest form of technical analysis, have bullish flag patterns in 10-year yield, gold price, and the oil price, all on different time frames, but they're all pointing higher. To me, that's maybe all you need to know.
It's good enough. 3 things that keep it simple as well. Simple trading is often the best trading, and everyone can focus on it. Jesse, thank you very much for your time. Brilliant as always. Love speaking to you. Hopefully we'll get a chance to do this again and see how this evolves, in a few months' time down the road. But thank you very much indeed for your time.
Thank you, Roger. I really enjoyed that.